Legends, we are live. Hope you're well wherever you are. It is the 2nd of December today. Welcome to the Daily Buyer Show, where we dig all charts as they relate to crypto. Bitcoin has dumped into the open of December. We've had first day of trade. First official day of trade. Wall Street's opened. Let's take a look at the charts. Let's see what's going on. Now, this dump is expected volatility, right? I said in yesterday's stream, my Substack, my weekly market update, by the way, is out now. I posted it last night. And I said in yesterday's stream that we are in the volatility window, right? So we are in the key volatility window over the next couple of weeks as we have heavy macro calendar events that likely dictate the trajectory of the next, definitely December and potentially into January Q1, right? The main consideration we're making right now is Bitcoin is clearly in a bear market, or I should say a macro downtrend. And you can see exactly why I'm bearish right now and have been for some time. If you just watch back on any of my recent streams where I break down Bitcoin's price, but we're in a macro downtrend, right? It doesn't take a genius to look at this chart, okay, to look at the Bitcoin chart and see that if you just flick it to the weekly, right? The weekly low was lost here, and this has been a significant move down. Now, this is the first time the entire cycle that the weekly low has been lost. And usually the weekly lows don't get lost. See, here in particular, don't mistake this as the weekly low, right? Because no new high was created from this low. This is internal price action. So this is a standard correction, right? A big one, but standard. Here's the weekly low when this high was made. The low's back down here. You don't want to fall into these kind of traps, right? If you need to learn a bit more about market structure, I've got heaps of videos in my building block series where you can see exactly how I draw market structure, the exact ways that I approach the market, the concepts that I use that have lent itself to all the success that I've had in the crypto markets. It's all in that building block series. But anyway, Bitcoin has been bearish for some time. The macro trend has flipped bearish. Bitcoin doesn't do this unless it's in a bear market, right? This type of price action. Now, where we sit currently is in a position where we've got a heavy macro calendar for potential liquidity events that could drive some type of relief and potentially a bigger counter trend rally, right? That's been the theme. That's been the thing we've been talking about on this channel for how long now? It's been at least, it's been quite a while, right? Pretty much since I started doing this daily show. We've been talking about the fact that we're bearish, and of lately we're coming into areas where we should expect to see some type of relief, and the fact that we do have those liquidity catalysts, potential liquidity catalysts brewing, that could drive some type of counter trend rally, right? Now, with the way that I approach markets, it all comes down to charts and data first, right? Price action trumps everything, and I need to see things in the charts and in the data to be able to execute and actually create my bias. I sometimes think of it as 20% speculation, 80% confirmation, right? So I speculate 20% of the time to keep me aware of potential environment, context, things on the horizon, things that matter. Things that, I shouldn't say things that matter, maybe things that could matter in terms of volatility, but 80% confirmation, meaning I'm looking for the speculations to be confirmed in the charts, right? Otherwise, they're all speculations, and there's many speculations floating around X and everywhere else. The problem is, those that often speculate aren't tracking the right data to confirm whether their speculations are correct or not, or to see whether speculations are coming to fruition. Which is what I do here on this channel, is we stick to data, and if we make a speculation, I don't even bother to speculate unless I know specifically what to track to understand if that speculation is coming to fruition. So our current liquidity catalysts, and call it potential speculations, building that potential liquidity cocktail coming into the end of the year or maybe Q1, are QT potentially ending, TGA, so the government going from refilling their wallets to spending, so they're actually spending money, deploying capital into the economy, and rate cut in December. So what do we track specifically to stay on top of those speculations? Well, the easiest one is the rate cut probability, which is still very high. The market is still expecting a rate cut in December, which is next week. Hence the volatility window. So expect volatility this week, next week going into FOMC, after the FOMC as it gets digested. Then the week after, we still have some more other macro events and macro data that will drive further volatility. But that's the first one, right? So rate cut expectations. That's what the market is speculating on right now in terms of liquidity anticipation. Speculation of QT ending in December. Well, how do we track that? We look at net liquidity. Specifically for QT, you look at the Fed's balance sheet, right? Because when their balance sheet is running off like this, that's typically QT, quantitative tightening, right? They're tightening their balance sheet, which is a liquidity drain to markets. When QE is happening, or stealth QE, or money printing in some way, shape, or form, however it gets done, whether it's called QE or something else, you'll see the balance sheet expand like this, right? Now, QT ending is not QE starting. That's a clear distinction people have to make, because I still see a lot of people running around hanging their hopes on QT ending, right? But QT ending just means that they're stopping the reduction of their balance sheet, right? So that might just mean it flattens. So hence, that's not a big liquidity driver, in my opinion, given the current market context and the way that charts are responding that we're seeing in the price action. QE, on the other hand, is when they're actually turning the money printer on, right? And we'll see that uptick in the balance sheet. Hence, speculation, that's how we're tracking it in the data. Possible TGA, so people talking about the fact that, the government's going to start spending, big, beautiful bill, all that kind of stuff, means that government's pumping money into the economy. Well, all we need to track there is the TGA, right? Because this is essentially the government's wallet. Now, we can see that every time they refill to this $1 trillion level, and they've been refilling since around about end of July, right? This is the level that they tend to fill to before they start spending again. So that's on watch. Now, again, if you've been keeping up with my channel, you know that I've got a free indicator that I give away called net liquidity. And what this does is it's aggregating those key things we just talked about, the Fed's balance sheet, the TGA, as well as the reverse repo market. And this gives us a really clear signal of liquidity into markets, right? You can see here when liquidity is expanding, in net liquidity, that's where we get these big parabolas. And liquidity has been on the decline since pretty much mid-July. We are seeing that slight uptick, right? Since the start of November, end of October, start of November, we are seeing that slight uptick in net liquidity, but it's not really meaningful yet. And again, this is driven by potentially the government slowing down. We've seen that they're slowing down that refill of their wallet. And we might be seeing that runoff of the balance sheet slowing down. So what we want to look for is if net liquidity keeps its trajectory up, that shows that there is actual liquidity coming into markets. And most importantly, what we want to be observing along with that potential liquidity bid is price action. Because price action, in my opinion and my approach to markets, price action is truth, right? Price action will either confirm or reject whatever speculation or narrative that we have circulating, right? Whatever your thesis is, ultimately it's reflected in price action. Okay, so just to quickly summarize on what we'd be looking for to actually be bullish on Bitcoin. Well, first and foremost, we need to see price action start giving us some reversal triggers as well as some higher time frame bullish structure. So we want to see the weekly start developing to a more bullish structure, right? Where it potentially creates a new lower high, because you can see here from this high, which is the all-time high to current price, we haven't got a new weekly high yet, a lower high. So in my opinion, if we make a lower high somewhere around here, then we come back and sweep this low, showing that sellers exhausted or buyers are stepping in, then we get back above this lower high, well, that would start to shift the weekly market structure in favor of the bulls. If we saw that along with this liquidity bid coming in, that's more of a scenario to be bullish about, and that's where I would start to shift my macro bias. But as it stands right now, we're still in a clearly bearish macro downtrend. Let's do a round the ground on the markets. All right, we've had our first close in Wall Street, so let's just head straight down there. Actually, is there anything else that we need to be keeping an eye on? We spoke about Japan not too long ago. We'll just quickly touch on it again. The Bank of Japan, Japanese liquidity underpins a lot of global liquidity. So if you're not sure or you're not educated on the carry trade, the yen carry trade, that's something I recommend you research. Basically, cheap yen is yen's borrowed for cheap and then deployed into risk markets globally. So usually converted to USD and then deployed into risk markets, right? That's essentially the core of the Japanese carry trade. So if the Bank of Japan starts increasing their interest rate, the risk is that that carry trade unwinds because the yen is incentivized to stay in Japan as well as, return to Japan, right? So hence the Bank of Japan meets now, let me just check on that. I believe their next meeting is mid this month. We'll just have a look here in the Forex calendar. And we did have Governor Ueda speak yesterday, which, I saw some write-ups on X that he was a little bit hawkish, potentially suggesting another rate hike to come, which could be a reason that the markets are pulling back today. Again, I don't really speculate too much around that stuff, why the markets move the way that they move. I just stick to the charts themselves, and we can see it in the structures, right? So Bank of Japan is somewhere down here, I believe. Japan, yeah, see, so 19th of December, that's probably the 18th wherever you are in the world, because I'm in Australia. You've got the BOJ policy rate. Okay, so that's going to be a macro liquidity / volatility event, because if they do hike, we've got to be keeping our eye on the USD JPY as well as the Nikkei, because the USD JPY gives us like that proxy view on the carry trade, because if it turns over, it means that the dollar is losing strength against the yen, which suggests that capital is moving back into the yen, which is a potential unwind of that carry trade. And if we see at the same time the Nikkei is turning over, well, the Nikkei is another risk market, right? So it's again showing us that signal on global risk appetite and the bid for risk markets turning over. So it would be a much bigger global signal of risk unwind and potential cooling, markets turning over towards some type of bearish price action. Hence, that's on watch. The DXY, right? We've been talking about the DXY over the past streams. We're still observing this cycle ending pattern where whilst Bitcoin's distributing, the DXY is basing and starting a macro bull trend, right? We're still seeing similar price action. Now, we have had this pause up at the highs here, but like I mentioned, this isn't really meaningful if it moves down like this to invalidate the pattern unless it's actually trending down again, back below these levels. Now, the other thing to consider is, I saw this on Capital Flows has been pointing this out on X a lot lately, where he discusses that or has been pointing out that DXY weakness doesn't always mean or doesn't necessarily mean the bids are going into the risk market, right? And that's true because DXY weakness just tells us that the US dollar is losing strength. So underlying, you've got to work out, or you've got to think, why is the US dollar losing strength? Because on one end of the spectrum, it could be the US dollar is losing strength because capital is being deployed into risk markets. But on the other side of the spectrum is the US dollar is losing strength because investors are losing confidence in the US economy, right? So those are the two considerations to make. Hence, why I've said in the past that rates alone, okay, don't influence net liquidity, right? Rates alone are not enough to be tracking to be bullish on risk markets, because all rates do when it comes to how Fed adjusts the rates, that is just changing the price of capital, right? So all it does is incentivize people to take capital and pursue growth or take on risk, right? Because they're just making capital. They're making the price of money cheaper, okay? Now, if for whatever reason underlying that investors are not confident in the economy in the US, it doesn't matter how cheap the capital is, they're still not going to take on risk, okay? So hence, I thought I might just mention that in today's stream, because Capital Flows does make a good point there, where if you're only watching the DXY and you're expecting it because it's moving down for risk markets to rally, you could get caught really off guard there, because there are many instances in the past where the DXY breaks down, the US dollar loses its strength, while the US markets also collapse or lose strength, okay? So just remember that when you see the DXY breaking down, it's not just a bid into risk markets. You got to look under the hood a little bit more and understand why the DXY is breaking down. Because if it's recession fears or economic fears, then it's not going to go into risk, right? It means risk will keep breaking down, more likely at a more rapid pace anyway. And I could probably show you a quick example of this, right? If we go to, I'll just take these drawings off the screen for a minute. And we go to, I'll put the S&P on here. Okay, let's go back to 2008, the GFC, right? So here, into 2008, you see at first the DXY starts coming down, right down to here, right? So that's the US dollar losing strength, right? Now, for this portion to here, okay, when you kind of read the story that's being told in the S&P with the DXY, right? When you look at the two together, this portion is almost like that blow off top where the market is still piling into risk, right? They're not concerned about the economy. But when we get from this portion of the DXY down to here, well, look what risk markets are doing. They're plunging, right? They're dumping significantly because from here to here, this is when the sentiment shifts from risk appetite to recession concerns, right? And not only recession concerns about the US economy. Now, what does the story tell you when we look further? Well, you see that in the DXY here, you see confidence return in the US economy. And I believe this is probably round about the time where all that Obama intervention started, right? Where they first created QE and all these programs to basically bail out the banks and bail out the US economy. This is when they actually, during the 2008 GFC, this is when I believe they actually started QE officially for the first time as like a monetary mechanism. So hence, you see in the DXY at first this portion where there was concern for the US economy switched from risk appetite to now, no, it's concern for the US economy, so we want to get out of the dollar. At the same time, we don't want to be in risk assets because we're concerned about the economy, to then flocking back into the dollar, but still not ready to take on risk because faith is returning to the US economy. However, not ready to return into risk yet. And then you see here, let me just clean this up, right? Then you see the shift again back here, where in this portion, after faith has returned into the economy, right? You see then the decline of the DXY here to here. And at the same time, the SPX taking back off, that's when risk appetite returned. Okay, so we went from the phase of, oh no, losing faith in America, in the American economy, in American business, right? You see DXY and SPX coming down together. Then faith returns. Okay, let's head back into the dollar because for whatever reason where faith has returned in the US economy. Then as the dollar declines again, while the SPX starts turning up, that's where risk appetite actually returned. Okay, so you see the story being told there. Hence, again, I'll just come back to capital flows point. If you're looking at the DXY alone and rate cuts alone, and expecting risk markets, just a very one-sided view where you think dollar down, risk markets up, and Fed rates cutting means dollar down, risk markets up, you could get caught very off guard if you're not analyzing the whole picture. Okay. A quick side. What do we have? A little side mission on that. So, continuing on, that's what's on watch with the DXY. Now, we still do have this pattern playing out. We are seeing some rejection, a little bit of relief here, but nothing meaningful as yet. Pattern's still well intact. All right, let's take a look at markets. We had that VIX shoot up overnight again. All right, explain some of the volatility. And the indices have been on watch, right? Because we had the test of the daily structure low, where we've seen where you get these heavy tests into the structure low with the bands after a major peak, and it could be some signs of weakness coming in. However, we did have that strong move off the lows to end out last week, and in my update, we mentioned that we really want to be monitoring follow through this week, right? Because if the in my opinion, we're not fully out of the danger zone yet. Sorry, I'm just trying to find where I wrote all this stuff into the update. DXY, yeah. So you can see it in the update here. All the high time frames still remain bullish. However, we've had those first signs of weakness come in, and we want to just monitor structurally what's happening, right? Because we're not fully out of the danger. With these major tests, the bands crossed, we've got to be observing price action back at the highs here, because if this is a longer drawn out distribution, we might see something like this, okay? Even worse is if it turns over lower here and then comes back in to create a new low here, and that essentially confirms a bearish trend on the daily. Okay, so it's still on watch. At this stage, we're just getting those early caution signs. No reason yet to be turning high time frame bearish on any of the indices just yet, but cause for close monitoring. Okay, and we are constantly monitoring these indices because the indices typically guide the general trajectory for crypto. Okay, so if the indices are having a big correction and coming down, crypto's usually already into its correction. Okay, now the NDX cycle ending pattern, I've talked about this many times in previous streams. It's in my recent Substack update as well. Okay, so we're still on watch with that pattern, which forecasts a potential end around the end of Q1. But if it turns over sooner, then Bitcoin's going deeper sooner, right? So that's the main signal we're monitoring there. But basically, all of the markets had a bearish open, but again, we're in that volatility window, okay? So this first 2 weeks of whether we see some type of resolution on these liquidity catalysts, whether they're going to come into fruition or not, this will drive the volatility across all markets, okay? And if they are coming into fruition, I expect the markets to start sniffing it out, potentially even earlier, and start to give us some price action. It doesn't necessarily mean that it just goes straight into rally. Sometimes it just looks like failure to break down further and base building, right? So specifically in Bitcoin, okay, if we head over here, and we start over the next 2 weeks, FOMC, and again, we're just hypotheticals here. Let's say the FOMC comes in with the rate cut. Let's say that Powell is particularly dovish in the press conference, and the initial reaction might be, okay, we push into the lows, even down to these lows. But then over the coming weeks, as more economic data comes out, the Bank of Japan rate decision happens, potentially we see the market fail to push low and start basing, right? See some sort of patterns that give us an idea that there's a failure to break down further and we're doing some type of base building. And at the same time, then on the higher time frames, we start to build more bullish structure. Okay, those are the kind of things we'd be looking for in the potential market sniffing out the liquidity catalysts coming into fruition. So it's not necessarily that the market needs to rally straight away. A lot can be told in the behavior at the lows as well. Like if it's failing to break down and then it starts to put in some sort of high highs, high lows and high highs on lower time frames. Over the course of some time, it develops the weekly structure. We analyze all those things. So before we step fully into the crypto world, last most important chart in the indices side right now is the NVIDIA chart, right? Because we're monitoring that potential deviation from the SPX. The NVIDIA often deviates bearishly prior to the SPX, leading into some sort of deeper correction. And for the most part right now, we're not seeing any drastic sort of deviation, right? It's still somewhat here. We've had a small bounce in the NDX, a bigger bounce in the SPX, but it's still not like a full bearish divergence from the SPX. So nothing of major concern there. Okay. Heading into crypto, our most important chart. Let's always start with that right now, because I mention, and I have been mentioning over our streams where if this keeps charging up, geez, all those bulls that keep calling for a massive rally are going to be in for even more pain and a bigger surprise. Because if this keeps charging up, crypto can go much lower. Alts can go much lower. Bitcoin can go much lower. This is basically telling you that participants within crypto itself are moving out of tokens. They're getting out, okay? So hence, we are watching this pause around here because crypto can move up, as seen here, right? Where we can move up a little bit further and then have a big retracement in stable dominance. And that would be similar to the massive counter trend rally we had in January 2022, where Bitcoin went from, where was it? It was 30K all the way up to 50K, right? Over the course of Jan to March, I believe it was. That's this counter trend rally. But what you notice is when that happened, the weekly TT bands never flipped bearish, meaning that it was still supported and the trend was still bullish. So hence we knew that was a counter trend rally because this needed to turn structure bearish along with the bands turning red to confirm that stablecoin dominance is actually structurally turning bearish. Okay, that's what we're going to be on watch for the counter trend rally that develops. If it develops in line with some of these catalysts, we're going to be watching behavior in stablecoin dominance because right now there's plenty of room to move down into the bands, right, and create structure and do a move like this without invalidating the bearish structure. And that could be the liquidity, the internal crypto liquidity for a big counter trend rally. But if the structure doesn't actually turn bearish and the bands don't turn back over bearish, then we should be expecting that it is just a big counter trend rally. And if it heads back up, we're going into that deeper bear market. Stablecoin dominance is a very important chart to be tracking. If you're not tracking it already, make sure you've got it loaded up. If you want these bands that I use, just send me a DM on X. I give away all the indicators that I use for free, and there's no rocket science behind any of these. You can make them yourselves in ChatGPT. These bands are just 1221 EMAs, and I've just written some Pine script code to flip them green when the 12's above the 21 and flip them red when the 12 is below the 21, so we can see these trends easily. Okay, and I use them a lot in crypto and especially Bitcoin. So let's do that. Let's jump into Bitcoin next. All right, and I've taken all our levels off the screen. Oh, have I? No, our levels are on this chart. These are our macro levels that we've been tracking. Okay, it's like I said earlier, it doesn't take a genius to see that Bitcoin's bearish, right? The weekly structure's bearish, okay? The weekly bands are confirmed bearish. See how they're red, right? Now, again, these bands, same bands, I use them on the weekly chart to map the macro Bitcoin cycle, and they're pretty accurate, right? I've back tested this for multiple cycles and they're very accurate. They're very good at just guiding the macro trend. Okay, when they turn red, you know that Bitcoin's in a bear market, it's confirmed. And you got to remember the bands, any type of moving averages are always lagging, right? Price action's your fastest signal. Hence, I use these as a confirmation tool. So once I know that these bands are confirmed red, we know that the momentum has shifted significantly by that point in time. So typically the bands will turn red when price is under the bands for a period of time. And then once they do turn red, especially when you're looking at this weekly macro time frame, you'll find that there'll be resistance until Bitcoin is ready to break through and flip the macro trend. So you see here how they turn green, we break through, and then look at how weekly structure is respecting, right? As well as respecting the bands, and the bands stay green basically the whole cycle. Now, we've done just that, where we've broken through the bands and the bands are red. Okay, so I am expecting At some stage, we're going to come, whether the bands come lower or price has a nice rally up, we're going to come into those bands. And usually that first major test of the bands is going to be leading into the development of some type of macro weekly high. Okay, and if you read my Substack, that's the main macro short that I'm looking for on Bitcoin. So I am interested. The main macro short trade that I'm interested is the development of this next weekly high. Okay, and when that weekly high develops, that's where I want to wherever that weekly high develops, that's where I'm looking to get short on the more macro swing timeframes for continuation in this trend, at least down to these lows here. Now, I have gone over in previous streams, specifically yesterday, in a bit more detail what I'd be looking for in terms of structures and in terms of key signatures when price is going to turn over. So I won't go over it again in today's stream. I'll encourage you to go back through yesterday's stream. And what we'll do is just quickly, while we're on Bitcoin here, we'll just go through what price action looks like over this first day, over these first days, right? So we do have this inside bar from last week. All right, so last week's low and high. So anytime there's an inside bar, we've got to observe price action at the extremes. All right. So right now, early in the week, we've come down to sweep last week's low. Now, it's still too early to tell if that's the weekly low being set in and if this is going to turn into some type of range where, you know, because we are potentially basing or setting up, you know, some type of structure to go higher and then create a new low. It's still early in the week to tell if this is the weekly low for a potential trade back up to the weekly high. But that's something to observe because we are at the extremes of that inside bar candle, which is basically a compression-like candle, right? It's usually indicative of ranging price action developing. Now, if we jump onto the daily, you'll notice that the daily bands rejected hard into the thick bands right here. Now, if we do go down to test this low here, that will validate this as our new daily structure high, right? So our primary daily structure high is here right now. So unless price gets above here, we cannot be bullish on the daily structure. However, now that we've had a nice retracement, if this leads to a new low here, right? That's where this daily structure high, this yellow level, I'll move it down to here. And if we get back above here, that means on the daily, we'll at least be bullish. Now, some of the things I'd be looking for as price comes down into this low, I'm always observing behaviors at the extremes and at the key structure points, because that's, to me, where market shows its intent the most, okay? That's where you see the market potentially showing its hand for what it wants to do next, okay? So when we do come down here, I'll be observing how price action develops around this low. If it's an SFP, right, a daily SFP on this low, as well as followed by another day SFP on the previous day, that to me is often a pretty strong pivot signal. And I might expect that if we're reclaiming there and start on the lower time frames again, start to put in bullish price action, that's where I believe we might at least be trying to come up to test this high here, right? And that might lead into the potential counter trend rally that goes out to develop the next weekly high. Again, until price action develops, this is speculation, but remember what I said earlier, 20% speculation, because the speculation sometimes allows you to build some trading plans to be prepared for what you'll do at the levels, okay? You should have some type of systems that you use to be able to obviously plan your trades, what kind of signals you're looking for, but then most importantly, how do you execute your trade? What do you need to see when price comes down to the level that you've planned for, Okay, it might be lower time frame confirmation. It could be whatever you use, right, in your own system. But essentially, if we're not at least planned for the levels, we don't know where we want to participate, you probably never end up participating. Or when you do end up participating, it's you're caught participating emotionally and not systematically, all right? Which often leads to you losing trades. Hence, that's pretty much what's on watch for me at the moment. If I just dig into the 4 hour, what I notice is we did come up into these first liquidity pools here, right? We just tapped them. We had this nice flip here, this structure reversal, okay, on the 4 hour. This is a pattern that's very present when price pivots and shifts its structure. All right, and we have come straight down to take these liquidity pools, like this 4 hour. This to me, as it was developing, I knew this was inducement liquidity, right? Anyone shorting here just got squeezed straight out, right? Because this essentially is the market just making liquidity so that it can come back and take liquidity. You always want to be looking for trades when the market is taking liquidity. That's where you want to be aligned for your trades rather than when the market is making liquidity. And I explained that whole concept, I believe, in the stream, not yesterday, the day before. Sorry, getting a bit of a dry mouth there. So hence, when we saw this price action developing down here, okay, we're in a bit of no man's land, right? We haven't really, the next key draws on liquidity are down here. Liquidity was here. So when we were in here, we're in no man's land. So what does the market have to do in no man's land? It has to make liquidity, okay? Induce people into the market to make liquidity. And then when it takes liquidity, it will make its move, okay? So you don't want to be trapped trading when the market is making liquidity, because that's when you become the liquidity. Right? Hence, when we're in here, again, if you look, you know what? I'll do a quick bar replay so that you can understand it a bit cleaner and clearer when I explain this concept a bit. Right, so if we go back to replay, okay, and we go select bar, here, when price was coming into here, and you were thinking, right, rightfully so, you were thinking, okay, price is bearish on all time frames, even down to the 4 hour, the daily, the weekly, price is bearish. So I want to get short, okay? And then you saw price doing this. Maybe you saw this and you thought, okay, it's starting to move. Maybe this is going to be a sweep, right? And you tried to trade this. You know, maybe you saw that and you go, okay, the previous 4 hours been swept. We're getting a reaction. I want to try to trade this because it's heading back down. Okay, and then you had a few candles in your favor, and then you would have got blown out, right? The reason you got blown out is because when you look at price action between the last two key structure levels, here, okay, and here, where is the liquidity between here and here? There is no liquidity between here and here. When you look at this price action, there's no other structure levels through here on the 4 hour, right, to suggest that there's liquidity there. So you got to think in terms of where are the liquidity pools on the chart? Where are the old highs and lows? Here's the next liquidity pool, right? Okay, so either the market needs to make liquidity, which is what it's doing, or it needs to take liquidity. So once it comes up here, it's taking liquidity, right? So at this point in time, the market, being that there's no liquidity between here and here, the market is making liquidity, right? So it's inducing you to come into the market and start shorting through here because, you know, everything looks right. You're trying to go with the trend and all that sort of stuff. And you might have been going, cool, we're into these moving averages if you're that kind of trader, right? And you're trying to short there, but you get blown out because really the market wants to at least take liquidity from somewhere here or generate internal liquidity to be taken. Now, in the instance of this particular price action, two things are present. Okay, first and foremost, now when I look at this leg of price, I immediately see that, okay, this is a higher probability, this is becoming a higher probability target to short, because now we have this liquidity that was never taken. So this is inducement liquidity. Okay, so unlike this leg of price here to here, where there's no liquidity to be taking in between, this leg of price here to here, we have this liquidity here. So at the very least, we could get a move from here to here, right? And then what do we get? Well, we know, right? And this is two things I want to point out. So not only did we take, but we took liquidity here, right? We also then had this liquidity to take, okay? So the people who were shorting here, we just took them out. So we took out this liquidity and this liquidity, and then we got the move, and look where it drops straight to. It drops straight to the next key liquidity pool, right? And that's where we're getting the bounce. So that's I guess, call out a little lesson on price action, specifically how I use liquidity pools in my trading, and I look for where liquidity is on a chart. So if you're analyzing price action on the 4 hour right now, well, we know that this liquidity is taken, right? So the next liquidity pools are here. We still have this higher liquidity here. Now this liquidity is all being taken, so the next draw to the downside is here. Okay, now from here to here, if we analyze fractal price again, from here to here, there's no real liquidity. Okay, so again, depending on what time frame you're trading, I'm not really interested in a short, because until price is at least back up into this liquidity pool or this one, because the market needs to make liquidity. So if it makes liquidity like this, then comes up, it's created a new liquidity pool, and then takes this liquidity and gives us the move, then that would be a more appealing short to get involved with. And we know that there's this liquidity untapped here and this liquidity here, so you might see that move back down. All right. That's a quick take on price action there. And if you're thinking, oh yeah, it's all well and good to, after the fact, call out that and look at that price action. Well, I did paint this exact setup out in the Discord. I'm actually a part of the Spec Traders Discord, where I'm active there daily. There's heaps of really good traders there. You got Fennec and Miad, who cover everything from macro to equities, indices, forex. They've been killing it there. I painted this exact setup out in that Discord and gave it to everyone there. But yeah, if you're interested, I am active there. DM me on X and I can give you my links. If you did want to be able to get in touch with me, but I am highly active on X and I'm doing these streams every day here too. So that's pretty much it for today's session, legends. Hope you have an awesome day wherever you are in the world. Please like and subscribe and drop a comment, follow me on X, all that kind of stuff. And I'll catch you at tomorrow's stream. Thanks, legends.